Hello, in this video, we'll be going through the statement of cash flows operating activity using the direct method, part 1. When we prepare the statement of cash flows, which is the statement that is required to be reported on the 10K that shows all the cash inflows and outflows that occurred during the year from the corporation, we break it up into 3 different sections as it pertains to what types of activities occurred. First, we calculate the net cash flows from the operating activities, then investing, then financing activities. When we're talking about the operating activities and we have to report the cash inflows and outflows, these are items that relate to the day-to-day operations of the company, such as selling and purchasing inventory, or if they provide services, then they're providing services. Every company has to pay for their operating expenses, whether they're collecting interest or paying interest, that's an operating activity. Having to deal with taxes is part of running a corporation. A corporation might have to enter a lawsuit where they either collect or have to pay, and collecting dividends. It's really important to remember that this is an operating activity. This means we have an investment in another corporation and that other corporation is paying us dividends. And the reason why that is included in the operating activity section is because the dividends is recorded as dividend income, and the operating activity, everything from the operating activity starts with our net income on the accrual basis, and everything relates to the income and expenses on the income statement. There are 2 different methods for reporting the operating activities. The indirect method, which there are 2 devoted videos just to show you how to do that. And then there's the direct method. The direct method provides, it's an alternative way to the indirect method for the operating activity. And what it does is it takes each individual income statement items and reports it on a cash basis. And so if there's an income statement item that has no cash flow, they're just not reported under the direct method. Here's an example of what a direct method operating activity section looks like. We start with our cash flow from operating activity, and we have our cash received from customers. This is just an example. This is not, I just pulled this from the internet, but you're going to have cash received from customers. So this is our revenue on a cash basis. Here's our cash paid to suppliers. So think of this as our cost of goods sold on a cash basis. Then we have our cash paid to employees. So this is our salaries expense on a cash basis. Cash paid for rent and utilities. So everything's on a cash basis. So we have our cash paid for insurance, cash paid for interest, for income taxes, etc., etc. And then we get to our net cash provided by operating activities. Okay, so this is the direct method. The indirect method, if you recall, starts with the net income from the balance from the income statement on the accrual basis, and it adjusts for all the non-cash income and expenses, and then it converts the balance sheet items into a cash basis. So at the end of the day, both methods will result in the same net amount, net cash provided by operating activities. It's just a matter of which method you use. However, the FASB requires companies to show the indirect method if they choose to do their cash flow statement using the direct method. So if they do the direct method, they also have to do the indirect method. If they choose only to do the indirect method, that's all they have to do. They don't have to do the direct method as long as they're showing the indirect. So most companies only do the indirect, because why would you do both of them when you can get away with just one of them? And the direct method is a lot more work than the indirect. So 99% of companies don't even use the direct method. They just show their statement cash flows using the indirect method. But we still have to learn it because it's still in the CPA exam, and it's still an option under the GAAP rules. And one more thing I want to clarify is that we have this direct or versus the indirect method pertaining to the operating activity section, the investing and financing, there's only one way. So it doesn't impact the investing and financing activities the way those are done. Okay, so let's get started. To do the direct method, you need a comparative balance sheet, which means that you have our current year, if we're doing a statement of cash flow for 2027, for the year ended 2027, and the prior year. So you need all the balance sheet accounts, and you need the current year income statement. This slide just shows the income statement account, which income statement account pertains to which cash inflow and outflow that is reported on the operating activity using the direct method. So when we look at our sales or service revenue, that's going to be converted into cash received from customers. When we look at our cost of goods sold, that's going to be converted to cash paid to suppliers for inventory. So this is just how it all kind of translates from the income statement into the statement of cash flows. This slide is somewhat of a cheat sheet, and I will get into it as we get into the examples and show you how to use this, because if I just go through it right now, I don't think it's going to make a lot of sense, but it's how we convert our revenue on our income statement to an actual cash basis inflow, and how we convert our expenses on our income statement to cash basis outflow. Okay, so let's start preparing our direct method activity section. The first line item is always cash received from customers. So we're going to go down this income statement, and we have to address every single item on this income statement. Okay, that's using the direct method. We're going to address every single income and expense items. We're going to start with our first line. Sales revenue is $1,800, but we have to convert that to how much should we receive in cash. So here's our $1,800. I'm just going to do this for all my slides. I have a little snapshot of the income statement, and this one is just a snapshot of all the revenues and gains on this particular income statement. So we have sales revenue of $1,800, and you have to also look, in order to do the direct method, and in the indirect, but you have to look at the related balance sheet accounts. You have to think, when we record this income statement item, this revenue, what balance sheet accounts is it possible to hit? So usually we hit accounts receivable, right? When we make a sale, we could debit accounts receivable and credit revenue. Or we could also have a deferred revenue. If one of our customers pays us in advance, right, we would debit cash, credit deferred revenue, and then because they paid us for some service in advance, and then as we provide that service and earn it, then we would debit this liability account and credit sales revenue. So when we're looking at cash received from customers, you have to analyze both balance sheet accounts. And you have to look at the increase or decrease from the prior year to the current year. And here we can see that our accounts receivable increased by $70. It went from $310 to $380. And our deferred revenue went from $50 to $80, so increased by $30. For each one of these line items on the operating activities using the direct method, I'm going to go through the T accounts to show you how all this came about, so you can see how it makes sense. And then I'm going to show you two other methods of how to calculate the cash paid from customers, or the cash received from customers, or cash paid for whatever expense we have. And so, so hopefully once you see all three, it'll make a lot more sense. Now, we had $1,800 of revenue on our income statement, and we're going to assume that this $1,800 is split between $1,000 was recognized from sales on account, so for the accounts receivable, and $800 was recognized from sales to customers who had previously paid in advance. So first, let's do the $1,000 from the accounts receivable. We said we got revenue, so we debited accounts receivable for $1,000 and credited sales revenue for $1,000. And then we had some deferred revenue at some point. We had cash received at some point, and now we've earned that revenue. So we're going to debit our deferred revenue and credit our sales. So here you see the debit to the deferred revenue. Well, let's look at our accounts receivable. If our beginning balance was 310 and we increased it by 1,000 and our ending balance is 380, that means that we must have received cash. Okay, because we had a credit. We must have credited our accounts receivable, which means that we must have received the cash. So we must have recorded this: debit cash 930, credit accounts receivable. Similarly, when you're looking at your deferred revenue, right? We had a beginning balance of 50. We said $800 was earned, so we debited our deferred revenue by 800. Our ending balance is 80, which means we had a debit to the deferred revenue, and that's going to be, where is that? I'm sorry, we had a credit to the deferred revenue, which means that we received more cash from our customers, right? They paid us more in advance, and we recorded this journal entry: debit cash 830, credit deferred revenue, which is what goes right here. So this green highlight is all plugs. So if you look at this, at our cash received, we had 930 and 830. That means we received cash from customers for $1,760. I want you to remember that number. Here's another way to calculate the cash received from customers. And this is personally my favorite way. And it's a journal entry format, because I think it's easier than having to memorize anything. So we're told in the problem that based on our income statement, our revenue was $1,800. So how would we record that in a journal entry? We would credit sales revenue for $1,800. Then we have to look at the related balance sheet accounts for sales revenue. And let's look at our first one, accounts receivable. An increase from $310 to $380, right? And an increase in an asset is a debit. So we would debit our accounts receivable by $70. And then when we look at our deferred revenue, we went from 50 to 80. So increase by 30. An increase in the liability is a credit. So we would credit deferred revenue by 30. And then there's a plug to make this journal entry balance, and that will be the cash. And look at here, the cash, $1,760. A debit to cash means we increase cash, which means we have collected it. So that's a way to also calculate the cash received from customers. This is really the fastest way. Another way to do this is back to that one slide that I said I get back to, right? Where we convert the revenue. This takes us from the income statement revenue to the cash basis revenue. What you do here is you start with your sales revenue per your income statement. That would be this right here. And you look at your related balance sheet accounts, and we look at it. First one is accounts receivable, and we know it increased. So we have an increase in our accounts receivable, right, from 310 to 380. And so we go back here and we see, oh, if we have an increase in an asset, that means we have to reduce our revenue from our income statement. So here we have a minus $70. Then we look at our deferred revenue and we see it increased, right? It increased $30. And deferred revenue is a liability. So I'm going to go here and I have an increase in my operating liability. It tells me I have to add that $30 increase into my sales revenue account. So now if I take my $1,800 minus 70 plus 30, again, cash received from customers, $1,760. Okay, let's do a concept check. Accounts receivable for Salas, Smith & Cho attorneys was $40,000 on January 1 and $52,000 on December 31. If total legal fees for the year were $800,000, then how much cash was received from clients? Well, we know that the revenue was $800,000. So if we're going to do our journal entry, we would credit legal fees for $800,000. Then we have to look at our related balance sheet account, which is our accounts receivable from our beginning of the year and end of year. So beginning of the year was 40, end of the year was 52. So it increased 12,000. And accounts receivable is an asset. So how would we record an increase to an asset? We would debit accounts receivable for 12. And then we have a debit to cash for the plug. To make this journal entry work, it's 788. And that's going to be equal to our cash received from client, $788,000. Okay. We're working our way down our income statement. And the next line item on our income statement is investment revenue for $10. When we look at our related balance sheet account, we don't have a related balance sheet account for this specific company. A company might have an investment receivable, in which case then we would have to look at the beginning and ending balance of that account. But for this specific example, there was no investment receivable account, so therefore we don't have a balance sheet account to analyze, which means that the entire investment revenue was received in cash. Okay, so I just want to, before we get to the gain on sale, want to highlight this investment revenue. Why would investment revenue be reported on the operating activity section? Think about that. Well, when we initially purchased this investment revenue is probably the interest income, or if we were a bondholder, we purchased a bond, or if we made an investment, maybe it's dividend income. So investment revenue is the initial investment outlay that we made, whether we purchased a bond or bought, shares in another corporation. That initial cash outflow would be an outflow for the investing activity section. Subsequently, whether we receive dividend income or interest income, or just have to recognize a portion of the revenue from the company, if we own between 20 and 50%, we have to do the equity method. So because that income is reported on the income statement, and everything on the income statement has to be reported on has to be addressed on the operating activities section, then we have to report this on the activities section as well. Okay, so our investment revenue would be reported on the income statement, so we're going to include it in our operating activities. So this is all cash, so we have cash received from investment revenue for $10, and then we have our gain on sale from land. Remember, this is the direct method, so we don't have to adjust our net income. Our starting point is not net income on an accrual basis like the indirect. This is just straight up report the inflows and outflows of cash. So the gain on sale is just a non-cash income statement account, right? So when we sold that land, right, and we had a gain, whatever cash inflow we got, which is $200, it's from that ongoing example that we've been using throughout these videos, that was an investing activity. But this is actually the gain on the sale of land. And for the direct method, it's a non-issue. We do not report it. I'm going to stop the video here. This is part 1. So we've covered how to account for the revenue items for the using the direct method. And in the next video, I'll be going through the expense items of how to treat those.